Hey guys, you've joined us live at Moneycontrol. I'm Manisha Gupta. Second day of the trade in 2024, and we already are seeing some trends setting up, and especially in case of crude oil prices, where the last couple of days have been on the stronger side. Where are the prices headed? What do you need to watch out for? For that discussion, let's go across to Kunal Shah of Nirmal Bang. Kunal, hi. A very happy new year to you. And while, of course, we are looking at lower volumes into the international markets, but what really is happening at Red Sea seems to be defining the premium that the crude prices are taking. I mean, yeah, clearly this could change going forward, but at this point in time, on what's happening in Red Sea, how do you see that impacting prices?
Yeah, so first of all, wish you and all the viewers very happy new year. Well, regarding what's happening in the Red Sea, it's one of the reasons why oil is up. At Red Sea, there is a major geopolitical conflict going on where the Yemen's Houthi rebels are basically firing missiles at the ships randomly, and because of that, the shipping operations were disrupted. Merck was the one who started, moving in. And again, it was being attacked. So now US is making sure, and US is being quite aggressive and is taking a stance to stop these attacks. And they are retaliating to the Yemen's Houthi rebels, all these attacks. So all this is creating uncertainty regarding the shipping channel, which is likely to get disrupted if this battle continues. If this crisis escalates and Iran is directly getting involved in this, then this can lead to abrupt rise in oil prices, which has not taken place so far. So geopolitical premium has just started to build in crude oil futures because of whatever is going on in Red Sea right now. But that is the one side of it. The way I look at it, oil market seems to be in a big dilemma after the OPEC members are not following the compliance of production cut, which has been decided in previous OPEC meeting. So for the first time after so many years after COVID, what I'm observing is the compliance of OPEC is getting weaker. And a lot of these quota, which were defined by OPEC Plus in the meeting, barring Saudi Arabia and Russia, all the oil producers are not adhering to that quota and are producing more oil than what they are supposed to as per the OPEC Plus. So this is not a good sign. Second, US oil production is moving up at a rampant pace. At one point, even I thought that the US production is going to decline, but the number which are coming is quite surprising. 13.15 million barrels is the latest number from US as far as the production. It is making an all-time high. So on one side, the geopolitical uncertainty is jacking up oil prices, and on another side, the fundamental of oil are from the supply side doesn't look very positive. So in all this, we believe that the upside, if it is coming, it's because of geopolitical news, but the upside is going to be capped because the supply side is getting stronger. And that's the reason, in entire 2024, our projections, if the geopolitical event doesn't take place, then the outlook for oil doesn't seems to be very bullish. So the weaker dollar theme, I don't think so it's going to have a major role on oil going forward. It's what is happening on the supply side, what is happening on the demand side. If you look at the demand-supply equation, supply seems to be higher than the demand going forward in next 3-4 months. And hence, we believe that upside is very limited. $68 to $75 is the range what I see for WTI, and as far as Brent is concerned, for the month, and as far as Brent is concerned, $82 and $70 seems to be the range.
Okay, 72 to 80 is where you see major part of the year behaving in. Kunal, would you also see two parts of the year really going forward? Because as of now, the other concern, as you mentioned, also is about the demand. The winters are not as extreme. There's enough stock with Europe as well. Chinese demand is on the weaker side too. How much of that impact do you see in prices?
I think, yes, my sense is that whenever there is going to be a spike in oil, which is coming, it's going to come from the geopolitical event, especially in the Middle East. So whenever you see a geopolitical event, prices may rise by $2, $5, $6 depending upon the intensity of the crisis. But barring that, it's going to be a weak year. It's going to be a year where at least first half is going to remain quite weak, and Chinese demand growth is weak. If you look at the US demand growth, that is also not very encouraging. Like you rightly point out, the weaker winter has already taken a toll on oil and gas prices, where we've seen a sharp correction in both these commodities. So the tricky quotient for oil to move up is only geopolitical event. Demand supply side, supply is going to be higher than the demand, and hence the trajectory for oil is definitely on the downside until OPEC, again comes up with another production cut by Saudi and Russia. But I don't think so they will do that because it's not working. So we are going to see oil remaining weaker going forward, at least first half of the year. Second half, don't know, too early to forecast for that. But the first half broadly remains sell on rise.
Since we talked about geopolitics, I also want to bring in the other macros. The street is waiting for the US non-farm payroll data that comes in on Friday, and perhaps the first direction on where the rate cuts could be happening, with 70% probability that it's happening in the month of March. How are you reading on that and impact of that as well?
Okay, so first of all, the non-farm payrolls data, even though the payrolls decreases significantly or the unemployment shoots up, all the markets have priced 25-50% basis rate cut well in advance. So I don't think so that non-farm payroll data will trigger any major direction for the market. But in case if there is a sharp appreciation in payrolls, then the narrative of moderate rate cuts will again start coming in, and hence you may see some profit taking in commodities. So right now, the consensus trade on the street is the dollar is going to remain weaker. We are going to see a rate cuts. And if there is any change in the economic data coming, major data like payrolls data or inflation number or GDP growth rate number, if there is any stronger revision, upward revision, then markets may, tend to shrug off. But the broader trend for commodities is going to remain positive. Mainly on account of the rate cut narrative, which is likely to 30% is yet to be discounted. Of that, 70% is already discounted. Because of rate cut, we are seeing the current prices. If there was no rate cut narrative, then oil would have been at $65 or $60 right now. So yes, rate cut narrative will continue to remain, continue to push up the prices, and non-farm payroll data, I think 70% of that is already priced in. So if you see a lower payrolls, don't jump and rush towards buying commodities. In December, it is discounted a lot of these negative data. Going forward in the first quarter, the data may remain subdued because of the lag effect of the QT. Every month they are sucking, they are draining $95 billion from the market, from the bond market, and the US balance sheet, which was $9 trillion, is right now somewhere hovering at $7.7 trillion. So lag effect of the tightening is going to be witnessed in next 1 month in US data. So commodities are buy at dips. Whenever there is a dip, at that time you indulge into buy. A lot of these rate cut narrative is already priced in.
Point taken that, Kunal. Thank you so much for joining us today. So buy on dip narrative in case of commodities, barring crude, of course, where Kunal believes that the first half could be on the weaker side. Good news, of course, for the Indian markets.